Welcome to Fin Street. We are going to talk about housing finance sector wherein the growth has come back. We have with us, the BFSI research analyst, that is Kunal Shah of ICICI Securities, to discuss the same. Kunal, welcome to the show. My first question to you is, we have seen AUM growth coming back to the housing finance sector in Q1 FY23. However, the net interest margin is lacking the loan growth. Your view in terms of growth going ahead, as well as the net interest margin, how it will pan out ahead?
Yeah, hi Abhishek. So on growth, many of the housing finance companies have reported the highest quarterly disbursements in any Q1 of earlier years, and there has been gained momentum on a quarter-on-quarter basis. However, on margins, it has panned out lower than the expectations for three particular reasons. Firstly, the repricing benefit is yet to reflect, and it will come with a lag. Secondly, when we look at it, some of the players like LIC Housing Finance, Repco, they have offered discounted rates and largely to retain the customers as well as to sustain the growth momentum. And thirdly, in Q1, generally the off-balance sheet transactions are relatively on the lower side, so that has impacted the overall net revenue. So this has been the three particular aspects on account of which NIMs were lower than the expectations. In terms of the outlook, so in a rising interest rate scenario, the player who is able to pass on the rate hike to their customers would tend to benefit the most. In fact, we have seen many players raising the rates in July, and we will see the improvement. And under EBLR regime, in fact, most of the players in the prime segment have increased lending rates by 140 basis points, and affordable housing financiers have also started to increase the rates. So we are positive on the margin outlook as we get towards the end of this fiscal.
Okay. Asset quality woes are clearly behind, as we have seen most of the HFCs reporting an improvement in their asset quality. Many of them have now started coming back to the growth front. What is your outlook in terms of how the stress assets will pan out, and how do you see the return ratios profile of majority of the HFCs?
So stress pool in the recent quarter was managed much better across all the delinquency buckets. In fact, when we look at it, many of the players on 1 plus and 30 plus DPD buckets, like say Home First and Actors, we had seen almost a 40% contraction in the delinquency levels from that peak. In fact, even Awas, when we look at 1 plus DPD, that has contracted more than 60% from its peak. However, maybe when we look at the delinquency print, that is still slightly away from the pre-COVID average, and it will take a couple of quarters to normalize. So in fact, even though there is improvement compared to what we saw peak during the last year, in fact, over next couple of quarters, we will see further improvement in the delinquency rates and credit cost across the board. I think that has come out much better than the expected, and that has been the key reason for the overall earnings which has been there in this quarter.
Kunal, you mentioned that disbursals have been strong in Q1 FY23 for majority of the HFCs. Any particular segment or any particular geography which has caught your attention in terms of disbursals?
So disbursals, particularly when we look at it, there has been gained traction, particularly on the self-employed side. So no doubt, salaried has been holding on pretty well, but self-employed and a loan against a property segment has come back over last couple of quarters. And when we look at it overall, say geographically, in fact, there is a demand which is coming in from tier 2, tier 3 cities as well. So in fact, there is growth in the prime segment as well as the affordable housing segment. And very interestingly, if you look at maybe the lending of banks to HFCs for the month of July, which is there in the sectoral deployment, in fact, there is month-on-month growth of almost 7% plus. So that clearly suggests that the trend for growth in HFCs is going to continue. No doubt, some would be the replacement of the debt market borrowing, but obviously the trend seems to be better going forward as well.
Well, Kunal, in your report, one of the report that you mentioned about HFCs, you have mentioned that quarterly rundown rate is declining. Could you explain to our viewers, what is that rundown rate which is declining and what is the outlook over there?
So overall, the rundown rate has come off, particularly when we look at it. Say for Repco, it was quite high at 22 odd percent on an annualized basis. It has come down to 17 odd percent. In fact, a rundown rate for Awas is also managed at 6 odd percent. For Home First, it is 5. For Aptus and LIC, it is 4 odd percent. In fact, our interactions with many of the loan aggregators also suggest that plain vanilla takeover purely to benefit from the rate has actually come off in the industry, and a significant portion of the balance transfer which is happening or rundown which is happening in the portfolio, that's particularly the enhancement takeover. So these are the top-up loans which are provided. But
Okay.
generally, in the rising interest rate scenario, we tend to see a relatively lower balance transfer out, and that's the reason overall we should see a better rundown rate going forward as well.
Okay. One last question, Kunal, since you track the sector so closely, how do you see the valuation re-rating happening in the housing finance sector, and which company, according to you, will see the highest re-rating going ahead?
In terms of the stocks in particular, given that many of the players are still available quite at a discount to the book value, be it say Repco is almost available at 0.4 times multiple, and we have more than 100% kind of upside in Repco. Amongst the affordable housing financiers, we have more than 20% upside for Awas. And LIC, maybe since maybe the margins should play out better, and that stock is also trading at almost 0.8 times multiple. There also we have more than 15% maybe the return expectations in terms of the stock price.
Well, that's a word coming in from Kunal Shah of ICICI Securities, who remains bullish on the HFC sector. Thank you, Kunal, for joining us on this show of FinStreet.
Thank you, Abhishek.